Welcome to episode 23 of Kontrarian Korner. I'm Ben Kelleran. Today we have a very special anonymous guest. You might be, if you're familiar with Twitter and the financial side of Twitter, you might have seen some of his posts before, but he goes by Shrub, and he's one of the most entertaining Substacks that I get the opportunity to read on a frequent basis, but definitely someone worth checking out. And we kind of have a similar focus on what's going on, broader markets, commodities, and some of the interesting market moves I guess the way I'll put it. So Shrub, thanks for coming on.
Thanks for having me, mate. I mean, the fact that it's episode 23 is going to disappoint a lot of people because they're going to expect a Michael Jordan and they'll get a Shrub. But
Yeah,
anyway,
well,
I'm just lowering expectations from now.
yeah, well, we'll have to see if we can get a Michael Jordan flu game performance.
Let's do it.
The
Let's give it a go. Fine.
I think it'd be interesting to start off with oil because we're recording this on Tuesday the 15th, and oil is getting flush this morning, like 5%, and it's one of those things where I've said multiple times that you can't make a bull thesis just for obvious reasons, but at the same time, I'm kind of wondering what headline has to hit the news tape for oil to react like something's actually happening, because nothing ever happens group is I think in for an interesting 2024 rest of the year and then 2025. But I mean, is it like they have to start hitting refineries or like Strait of Hormuz? Like what do you think has to happen for geopolitical risks to start getting priced into oil markets?
Yeah, that's a good place to start. So, first of all, and this is going to resonate with a lot of the gold bulls that are listening right now. So the gold bulls were the most suffering group of investors for the last 10 years. And suddenly they got their moment
until the last
couple
6 months.
Yeah, until the last 6 months. But they were the most depressed individuals on the planet that I was interacting with. They were kind of also like a little bit like the joke of as a sector, right? They were like the butt of the joke.
Yeah.
So
Peter
right
Schiff
now,
types.
yeah, and they were proven right. They are being proven right at this point. So I think the most ridiculed and exhausted group of individuals right now are probably the oil bulls, and it's partly in their own making, because when you introduce geopolitical risk as your investment thesis, that's usually a really bad investment thesis. So if you're investing on oil for the risk of something happening in Iran or Israel or whatever, it hasn't worked out for the last God knows how many years. I mean, the Middle East has been a complete mess since I was a kid anyway. So it's not like it's a new thing, right? It's always been
decades.
It's always been a problem. It's been, I mean, since I was a kid, I remember, because I grew up near the area, near the region. I mean, nothing's changed. Nothing's changed in reality. It's just that the guns got bigger. So there's that. So how does this turn? But having said that, because the guns got bigger and the capabilities got stronger, I actually find it really, really complacent how everyone just assumes, well, nothing's going to happen because nothing happened last time. So there is that small possibility of something happening in the oil market, and that something could be like hitting one refinery. I don't think they're going to go as far as closing the Hormuz Straits. I mean, the Hormuz Straits is basically where, I can't remember what the percentage was, but I think it's like 20% of, or 20 to 30% of seaborne oil trade goes through there. So
I've heard it's 20 to 25. Yeah.
Yeah, it's around there. Yeah, it's around there. So I don't think anything's going to happen there, but you wouldn't be surprised if they hit a refinery, and then the obvious question is, what does that do to the oil price? The answer is it probably goes down because Iran is going to have to export more crude instead of products, I guess. But to summarize, it's pretty difficult to invest on oil based on that, and that raises volatility of the oil price, and that also gets a lot of tourists in that get whipsawed and then end up losing money. So the one trade I did a couple of weeks ago, that actually did work out. You remember when the Hezbollah pagers were blowing up? Well, oil
Yep.
was below 70, and at that point, it just seemed so complacent after such a major escalation, where Israel pretty much infiltrated, Lebanon and Iran. You would expect a reaction by Iran. So that with oil, when oil was at like 68, 69, that was a good opportunity to buy calls ahead of any possible escalation. So the way I saw it was, it's a cheap option, not cheap because volatility is pretty high, but it's an option worth taking just in case something happened. And it did happen. So oil had like a 7-8% run. I mean, the calls went up like 2-3 times. So it did work out. And now we're kind of back at the same level today. So today that we're speaking, it's a Tuesday. Oil is down 5%, 4-5%. So, the question is it worth spending a bit of premium to hedge that risk of any escalation? To be honest, it probably is. It probably is. And, the only thing that should be stopping someone is that the volatility, as I said, is pretty high. So there's only so much you can do. But, let's put it this way. Imagine you're having a good year in the market. And, I'm having a good year and I have a portfolio invested in stocks. Well, what do you do to hedge it till the end of the year? Well, if you buy some oil calls, it's probably not a bad idea, but I assume they're going to go to zero, I guess. So that's the short term. That's the short term. The long term is a bit more tricky actually, because we're all focusing on the short term about the Middle East, but long term we're still using oil. So the problem is, like, with these short term gyrations, I'm not even thinking about the long term thesis around oil. So for example, I only have one energy position that I've had for the last year or so, and that's not doing very well either. But that's the problem with that with the geopolitical risk around oil, is that we forgot everything else around it. So I would actually, bizarrely, I would turn more positive on oil only after the Middle East is not talked about, or just put to rest. I mean, it's never going to be put to rest, but unless we're all dead by then. But when geopolitical risk is no longer the topic of discussion, but more like, is OPEC gonna, how's the OPEC spare capacity looking, or how's demand from China looking? That's kind of more interesting for a long-term thesis around oil.
Yeah, I think you have a good point there. And one of the things I think is interesting is, if you do get things calming down in the Middle East, then you're less likely to see like the price action basically whipsawing everyone around, where it's like 5% swings in a day, which, I mean, I don't think there's anything except for kind of the news headlines and algo trading type stuff having that kind of impact, just because, like, for a market the size of the oil market, like, you'd kind of expect it to be less volatile than it has been over the last 6 months to a year. But I think also when you look at some of the Permian Basin stuff, and I mean, if you said oil is going to be at 70, all these companies in the US are making investment decisions for 2025. Like, the people that still expect the Permian Basin to grow production, like, in over the next couple of years, I think they're potentially in for a rude awakening. So
Yeah, that's exactly right. I mean, those are more interesting discussions because, the Middle East, it's been hot for a year, since October 7th, 23, but you can easily see that de-escalating. Whereas the Permian production going down, well, that's a longer term trend. And imagine the reaction when that actually materializes. That's going to be a pretty big thing, because we're kind of used to the US leading on the supply growth side, right?
well, that's all the world supply growth for the last like 10,
Yeah,
15 years, basically.
exactly. So that's
Yeah.
a more
So
interesting question. I mean, the only area I'm actually invested right now is actually I only have one offshore oil services stock. That's about it.
yeah,
Because I would have
I think
assumed
that,
that growth comes out of offshore, but it's not happening at this point. So,
yeah. At least not yet. I think the thing that's interesting about some of the offshore drillers and the deep water stuff in particular is I was kind of like, I guess, looking at it a couple of years ago, or I guess a year and a half ago now, um, and kind of assuming that day rates are going to go higher and quickly. And one of the things that other people have kind of talked about, and I've kind of come to realize, is the contract length is going to basically slow how fast it actually hits the contract books for some of these companies. And
Mm,
I think it makes it a longer longer term story where like you look at that and shipyard capacity, all these other things, and like you could easily picture an offshore bull market for deep water out past 2030. But at least the next year or two, it looks like we're probably gonna digest kind of that for a little bit. So I think
yeah.
that's the most interesting sector to be looking at for the most part, unless there's certain special situations, which I've been talking about a lot. But I don't know if there's anything else that you find interesting in the oil sector, whether it's some
No,
of the
I
producers, some of the,
not really.
yeah,
I actually grew to hate the producers. Like I like to play them for momentum. Um, for example, I kind of like if I'm bullish oil, I buy Occidental, for example. I just keep things simple. I really hate buying billion-dollar producers nowadays. But I'm kind of like, uh, I have enough battle scars with smaller oil producers that I don't really want to get into it, into them again. So the way I do it is, if I'm bullish oil, I buy the big ones. I buy like Oxy, maybe I buy Shell, um, or I buy the offshore drillers. I mean, the offshore drillers to me are like the best spot to focus on because they're winners out of uh, a capex cycle, and they're winners out of if oil is at 100, these guys are going to be charging 1 million day rates. So I'll just give you my quick thesis on it, by the way, because it might help. So imagine that these companies have these massive rigs that are in the middle of the in the middle of the ocean, and they used to cost 300 million to build, but now they cost like $1 billion to build.
at
And you can
least.
pretty much, yeah, at least. And the shipyards that build them are actually at full capacity for other types of ships like tankers and dry and bulk carriers. So suddenly, the places that build these offshore rigs are pretty much full for the next 5 years. So you can't actually build one. Even if you wanted, you wouldn't be able to build one. And even if you wanted to build one, even if you could, it's not going to be like 300 million anymore. It's going to be $1 billion. And these things, they get rented out for, well, they get the contract price is like say like 400,000 a day. And in reality, in a proper bull market, that 400,000 a day goes to $1 million a day, which we obviously haven't seen. We've only been up to like 500. I think the high was like 500. So
Yeah,
that,
I think if you go out a couple of years, you're looking at like 650 on some
yeah,
of the highest
650.
spec, but
But
that
yeah,
starts in like
Transocean.
2028.
Yeah, Transocean did that trade at 650, which I think was a pretty bad trade, actually. I mean, it was a bad
Yeah.
trade for the whole industry because 650, but 2028, if you discount it, you're like at 500-ish for an eighth generation ship, which was like completely the wrong thing wrong message for the industry. But Transocean is a levered play, so it's a levered company, so they kind of almost had to do it to make sure that they are going concern in case that there is a bear market in rigs. So anyway, so my thesis was, find the companies that don't have too much debt, like, Valaris, Noble, even Seadrill, and just say, well, these companies don't have much debt. They get, pretty nice rates today. If oil stays where it is, there are no new rigs coming for the next 5 years. And like you said, I can imagine a bull market for offshore rigs for the next decade. That's the thesis. The bear case now is, well, there is that white space in the next 12 months, and the contracts, like you said, are shorter, and they're switching from one to the other still. So they used to charge 200,000 a day, then 300,000 a day, and now you have a bit of a white space before you go into, what you thought were high rates, but they're probably going to stay a bit subdued for the near term. So you're going to have like another kind of lukewarm year, 2024, 25. But the market, is a pretty short-term. I mean, I'm a short-term trader myself, by the way, but I like to have a long-term portfolio, just to be clear. So but the market there's no one in the market right now that holds long-term positions seriously. So the market is not saying, oh, these things are going to print 20% free cash flow yield for the next 10 years. So they should have been three baggers. But the market is saying, no, screw that. They're going to have a terrible Q4 2024. Because the market is dominated by short-term traders like pot shops and hedge funds that kind of, they used to have yearly targets, and they moved to quarterly, and now they're monthly. So no one's going to hold an offshore driller for a 2026 story, which is where we are.
Yeah,
And
the
that makes it
institutions
interesting.
where I was just gonna say the institutions where 6 months is long term to that group.
Yeah, exactly. I mean, which is a complete joke. Like, imagine, if institutions have like a 6-month long-term target or 1 year long-term target. I mean, that's still not enough. You kind of need people to think like 5-10 years for this thing. But instead you have a bunch of jokers in the market, like, well, I'm not going to mention names, but let's say the disciples of disruptive tech that buy only cash burning companies. I mean, they think in 10-year terms, but too bad that their companies they invest in actually burn through their cash in the first year. So those companies are worthless by year 2. So if you think about it, it's a complete joke, right?
No, but Tesla's going to a 30 trillion market cap. Haven't you
Yeah,
heard?
exactly. Yeah, exactly. That's that's the biggest problem, is that the only long-term money goes to like cash burning companies that are actually probably going to go bust without another round of financing, and then you have these companies that are completely forgotten and no one cares about. And we only talked about offshore. We haven't even mentioned the onshore oil services, that those ones like no one cares about.
Yeah.
So that's even worse. Like,
I've looked at a couple of those, and I was just trying to figure out like what like really kickstarts the cycle for those, and it kind of just basically ended up in the too hard pile. But with the offshore stuff, I think if you take a long-term view on it, you're basically investing in this bottleneck where you have the runway to where day rates need to get to make new builds economical, and then you have the runway of how long it actually takes to get those new builds. So it's like you said, not a 1 year type story, but longer term, I think it's going to be a pretty interesting place to be.
yeah, exactly. I think that's the kind of trades you want to be thinking about for a long-term portfolio, or like a sleep well portfolio type thing. I mean, you can never really sleep well if you own commodities or cyclicals. Let's be clear about it. But at least you have something that you don't worry about. If you think about it through the cycle, if it works out, you'll make multiples your money. Let's put it this way: you're going to make multiples your money without that much downside. So if you, like a Noble, for example, I can't see Noble going bust again. Okay, everything is possible, but famous last words, because they did go bust in the past. But say it goes bust and you lose 100%, but on a proper cycle they do like 3 times their money. Well, you have a 3 up 1 down kind of thing, which you obviously can't get with Nvidia. Again, famous last words, maybe you can, and it's 10 trillion company. So no, basically it's all about portfolio construction and how much you want to risk in one space. So the way I see it is I only have one energy position, so I can live with it going up and down 50%. I don't really care. If I had 5 of those in the same space, then it's a different situation. So I think that's where portfolio construction comes in. And to be honest, at this point, I'm okay to have like 5% in energy. I'm not really. I don't really want to have more, to be honest, at this point. I'm still a bit. Like I said, I don't like this geopolitical ping pong, and I kind of want to just see the next few months go through. Even we haven't even talked about the Trump trade, because the Trump trade is sell oil, because he's going to force everyone to pump, or get everyone to pump, which, to be honest, it's another fallacy because what? I mean, U.S. is at a record production already, so it's it's not like Biden was stopping them from drilling, right? But anyway,
Yeah, I think
it's all
that
about
too.
narratives.
People,
It's all about narratives.
yeah, it's goes back to your point of once you realize it's all nonsense, then it all makes sense. But
Exactly.
the
Exactly. Once you're exactly. That's my favorite
the
thing.
with oil, I mean, people say, "Oh, Trump is bearish for oil," and it's like, well, maybe for the price and maybe just near term, but you kind of look at what that would mean potentially for like capital spending for the sector. It's like, well, that's not going to be. It's not going to mean the same thing for every subsector of energy, but I think it'd be interesting to move on to another commodity that we kind of both think is pretty interesting in the next 3 5 years, which is platinum. And
Yep.
I think that's we were kind of talking a little bit before recording, and I basically said if I had to close my eyes for 5 years and could only hold one physical commodity, like it'd be platinum, because I think there's just a lot of things that line up where there's some parallels to where uranium was maybe 2020, 2021, where it's just you're just not going to see the same, like it's very asymmetric. Downside risk, I think, is pretty limited at this point, and the potential upside, especially if we see some catch up to gold, then I think it's a pretty interesting risk reward. So I'd be curious to hear your thoughts on platinum and the miners.
Yeah. So to me, platinum is exactly like you said. Basically, um, we can just summarize it this way. So platinum is cursed in a way because it doubles up as an industrial metal and a precious metal. So at the worst times, it acts like an industrial metal, and at the best times, it acts like a precious metal when the precious metals are forgotten. So right now, you have platinum trading around $1,000 an ounce. Gold is trading at, let's see, gold is trading today at 2650. So platinum is at the biggest discount it's ever been relative to gold. So you're talking about like a 60+% discount to the gold price, which is actually insane if you think about it. Because if you go to a jewelry shop now and you buy anything platinum, it's going to have a 10% premium to gold, which is insane. But
Well, that's where you just
historically,
bring your own platinum to the jewelry store and say, "Here,
yeah,
melt this down."
exactly. Exactly, but historically, that's how it was. I mean, when I first started in the industry, platinum was trading at 150% premium to the gold price, for a very simple reason that platinum is way, way more rare than gold.
It's 30 times, right? I think that's
Yeah. So
yeah.
the thing that we always compared about is these Olympic pools that you can fit all the gold in 3 Olympic bowls, all the gold in the world. You can fit it in 3 Olympic pools, and then platinum you can only fit one up to your ankle. So that's the scale of the scarcity that's there. Um, so so platinum basically has a few problems and a few bull cases. So the other problem it has is that about 30-40% of the demand comes from the catalytic converters for ICE vehicles. And we all know that electric vehicles are going to dominate the world, right? And no one's going to drive petrol-fueled cars anymore, so no one's going to use platinum. But actually, that's the bear case. But the bull case is if you actually look at the sales data right now in Europe, I remember the August data was auto sales were down double-digit, but actually there was one category that showed growth, and that category was actually hybrids. I remember the electric vehicles were down a lot because of the end of subsidies. And the one category that was actually up on the year were hybrids. And the interesting thing about platinum and hybrids is that actually hybrid cars take a bigger loading of platinum than your conventional ICE vehicles by about more than 10%. So ironically, the move into hybrids, which is the fastest growing segment, is actually very bullish for platinum, which is a very, very interesting side. So that's the industrial bull case. Now, the precious metal bull case is that obviously, the U.S. is printing about the U.S. is issuing like $5 billion worth of debt a day, and that's equal to the U.S. supply of platinum a year. So that's the scale. That's the scale we're talking about here. That basically, and this is about the currency debasement aspect of commodities in general. Like the deficit has become so big that it's basically comparing the amount of platinum mined over a year is equivalent to the U.S. debt growing in one day. So that gives you an idea. So, and then if you want to take it a step further, I think the most bullish thing that happened to platinum, bizarrely, is that Costco is starting to sell platinum bars. And as stupid as that sounds, it actually makes a difference because the platinum investment demand is so small. If you say like, let's just say the 5 billion, let's just say it's like $1 billion a year or something. I think just the ETF is $1 billion. Just the platinum ETF is only $1 billion. So let's just say there's like $1 billion of platinum investment demand. When Costco introduced gold bars they started selling gold bars back in August of 23. And since they did that, gold went through the roof. I think it was up like 40%. Like basically Costco actually they called the gold bull market, which was crazy. Like I'm just getting the number now because I found it like insane. There you go. So they did it in like August, and since August 23, and it was up 40% since they did it. And the best part is that Costco is selling $200 million worth of gold a month. So if you think about it, I found the number. So the investment demand for platinum is around, I kind of did a back of the envelope, and I came up with like 500 million a year, only $500 million a year. So if you think that Costco itself, just Costco, is selling $200 million worth of gold a month, imagine like a small difference that shifts from gold to platinum, or when people go and see, geez, why is platinum why can I buy platinum so cheap relative to gold? So I think it could make a difference. I mean, I don't know if you know Tesco, but Tesco, this UK grocer, they have this motto that says every little helps. So in the case of platinum, every little helps. So you have this $500 million investment demand a year. Imagine if like just Costco increases that by 10%, like $50 million a year. That kind of makes a difference. But here's what I really like about it. And, that's why when I kind of hedge my currency debasement, I buy platinum. It's a small market. Platinum is trading at a break-even cost for most miners because like 80% of the supply comes from South Africa. And so the supply side is non-existent. Like it hasn't grown for the last 10 years. And all these miners, they're losing money or break even when they mine platinum. So it's like you have this precious metal that no one's making money on mining. Supply is not growing, demand is okay, and it could actually increase for the reasons we discussed. So I think you have a pretty good setup to just own it and sit on it. Like it's one of only 2 commodities that I own, and I just sit on it. I just see it as like parking money, almost. I don't want to say in cash, but like that's kind of like my inflation hedge.
Yeah, I think it's interesting too, because like you're saying, every little bit counts as far as taking physical metal off the market. And it's a very much smaller market than like gold or some of the other metals. And I mean, the physical market and financial paper markets can be disconnected for a variety of reasons, like we've seen in oil, for example. But with platinum, I just think there's a lot of things that line up where I just have a hard time seeing it bumping around $1,000 an ounce for, any sustained period of time, whether it sort of gets up off the mat this over the next 12 months or if it takes a couple of years. Like I think it's pretty much inevitable, just a matter of how long it's going to take. So, and I mean, if you get that, then the miners are pretty bombed out at the current prices, so they look pretty interesting.
Yeah, exactly. I mean, are you playing it with the miners as well, or just?
I own a small piece of Impala, so that's my
Yeah,
I
that's the
had
only one I own. Actually, that's the only one I own.
yeah, I owned Sibanye for a little bit and dumped that after. I mean, I don't know, it was getting hammered, but I basically kind of looked at the logic again, and decided that they are like the Frankenstein's monster of a whole bunch of different assets, and if I just wanted a miner that was gonna give me exposure to platinum, then Impala was a lot simpler and
Yeah,
had a balance sheet where it's not as much of a dumpster fire, and I still think it has the potential to basically rip higher if we get a bull market for platinum. So I think it's a little bit less downside there than Sibanye. But I know a lot of people love Sibanye, so it's
yeah. I don't know.
that
I'm kind of, yeah. I know what you mean. I
it,
kind of
it's
prefer. I prefer to just with these companies. I generally just want to have less levered, less levered plays with good balance. You want to have like a good balance sheet, and you want to have like sensible management as well. So I think in the case of Sibanye, the problem is that the balance sheet is too stretched. So you really like if you get a proper bull market, you'll make a lot of money on it. But the problem I see with the platinum market today is that there's still about 3 million ounces of above ground stock. So those 3 million ounces. So the numbers are pretty simple. You have 1 million ounces of deficit a year, and you have 3 million ounces of above ground stock. So you need 3 years to clear out the overground stock, which you don't really need 3 to get the price moving. Say you need 1 or 2, that means you need to be patient for 1 or 2 years. And if you have a stretched balance sheet, you might not get a chance.
yeah. I think to your point, like the torque, like people talk about the torque with something like Sibanye, but I mean the torque from owning any of these companies, I think really it's more important to get the torque on what platinum's going to do. But I think
Mm.
to make sure you don't get carried out, that's where like you're saying, the balance sheet kind of is important. But I think if we want to shift to kind of one of the other commodities that I think is one of the most interesting setups for a variety of reasons is kind of the coal sector. And
Yep.
it's not like you're going to be getting 2020 prices or kind of those sort of returns that people have seen in AMR and others over the last, call it 2, 3, 4 years, however long it's been. But as far as any commodity equity sector, I think the coal sector probably has the lowest downside risk of anything if you're going to buy and hold and sit on something for, say, 5 years. So I'd be curious to hear your thoughts on coal and some of the equities in that sector.
Yeah. Bizarrely, I actually don't really care much about coal here. Uh,
Hmm.
the only one I really liked was Peabody. Like, actually, let me just step back a bit. So you have a few. The met coal market has a lot of China risk to it,
Hmm.
the China steel industry. Then you have the thermal coal market, which actually has a pretty okay story, bizarrely. So the one that people wrote for dead was thermal, and they got excited about met, but actually met probably has a couple of bad years, maybe. I mean, China is a whole separate discussion. So let's just put that aside for now. So the Met guys, they did very well. I used to own Warrior, which they're building a pretty good project. But I thought it got to fair value. It's at 60 something. Maybe it's worth 80 over once they finish their mine the next couple of years. Fine. But I don't really want to own coal names to make 20, 30%. Like I want to own coal names to make a few bags out of it, a few
Hmm.
baggers out of it, no bags. Otherwise they do turn to bags. So the one that I actually liked was BTU because it was really, really cheap and unloved, and it had a lot of cash. I mean, it's still cheap. I actually sold it because there was a nice run to it. It had a nice run, so I got out. But it's still a cheap stock that people hate. So I'd be more looking to that, to be honest, versus an AMR. I think AMR reached my fundamental value like ages ago. Let me see where it is, because they actually had I think they had an update just today. So it's still at 200, 220. Geez, I mean, AMR went from 400 to 220. Geez. So they literally gave up the whole bump of the last year.
Yeah, I think they had a good chunk
Interesting.
of insider selling right there around 400 something, and the buyback slowed down and a whole bunch of other things. But I mean, right here around 200, if you get down to 150, then I think it's pretty interesting. But
Yeah.
I think, like you're saying, Peabody is, I think, arguably still the cheapest, even after the recent run. I'd been trimming my cold stocks to buy Sable Offshore, so that's been mocking me. I did it right before the China stimmy announcement, so that's been mocking me for over the last month or so. But
Nice.
I think it's it's a sector where I think over the next, call it 3-5 years, I think there's, if you get another year like 2022 where you see supply issues and people panicking, I think it's not like maybe it takes a couple of years to get through some China weakness for the Met side, but I think
Yeah.
it's like I'd take the over on 80 for Warrior by when their project at Blue Creek comes online, but that's just me. So I think it'll
Yeah.
be interesting to see at least what happens with their capital returns there. So
Yeah.
um,
I would actually own, like, if you're a long-term holder and you can, hold on to it. I think Warrior is going to be just fine. Yeah. I mean, look, Warriors. I actually like what the management has done. The fact that they kept their balance sheet in a very strong position until they finish their project. They were told off and people hated it, but actually it's outperformed AMR over the last 1 year. And when you have capex risk, they've done the right thing. And I wouldn't be surprised if they get taken out, to be honest, in the next few years, because there's not much else you can buy. So I like for long-term holders, that's probably okay as well.
yeah, I think it is interesting, like you said about them getting taken out. Was it console and Arch merging? I think I think that's an
Yeah.
interesting sign that it's. I mean, if companies that size are merging, I wouldn't be surprised to see more M&A here in the next couple of years. But we'll have to wait and see on that. I think
Yeah.
it'll be interesting to watch. I think there's stuff in there that's just too cheap, and if you look at some of the capital return stories and the potential capital return stories, it's pretty interesting. But are there any other commodities you think look interesting right now? I know there's certain
Yeah.
things
Look,
that have been ripping with the China news, but I'd be curious to hear your thoughts on anything outside of the ones we've already talked about.
yeah, look, I was actually a few weeks ago, just before the Fed meeting, I actually went, I took a big chunk, I took a big stake. Sorry, I put a big allocation of my portfolio into miners because I thought the Fed was going to be dovish, and I thought there was a increased probability for China to actually launch a stimulus. So I went the easy way. I bought Anglo American, Glencore, Tecominco. I just bought the big ones, and then when I got lucky, the stimmy was announced. The China stimulus was announced. The Fed did 50 bips, so they had a 20% run, and actually I sold all of them. I got out of everything because I actually think what China is doing is more consumer-led stimulus, which is the right thing for them. But I don't think we're going back to massive infrastructure spend. So, these commodities are kind of like fairly priced. I don't think there's much, there would be much surprise or much boost to construction-led commodities. But the one commodity that I've kept, so the only two commodities that I have in my portfolio is actually platinum is one, and the other one is tin. So tin is a long-term position for me. I've had it for years now. And I think tin looks amazing over the next decade. Tin is like the glue that sticks the semiconductors together. The supply side is a disaster again. There's no supply. I've looked at all the junior miner projects that came up. They're all crap. Most of them, like, I think I'd like to say all of them are not going to get built, but maybe like one or two actually manage to get built, but that's about it. The demand side is pretty strong. And I think tin, the commodity itself, is going to have a good, strong run in the next few years. And there's not that many ways to play it. There's only like one company in the DRC, Alphamin, and one company in Australia called Metals X. I mean, that's about it. So it's a very niche commodity, but very interesting upside for the next few years. So that's about it. I don't actually have anything else on the mining side. If you asked me like 3 weeks ago, I would have told you like I've got 15% of my book in Glencore, Anglo, Tech, plus calls on top, bull, long, everything. And now I think it actually got priced in 2 weeks. I got out of everything. And by the way, I mean, most of these stocks are like 10% lower already. So maybe I get back in at some point, but I'm not there yet.
Yeah, I think, like you said, tin's interesting. I owned Alphamin for a little bit, but I wasn't willing to take the brain damage that would require to own any, at least for me, any significant size of that, with it being there in Congo. But
yeah,
I think, like you said, tin is a very interesting story, and one that's not followed basically at all by a lot of investors. So I think that's pretty interesting. But I guess before we kind of wrap up, I'd be curious to hear your thoughts on kind of broad markets as well, because I think there's a lot of stuff going on where the automatic kind of reflexive move is basically S&P higher for a variety of reasons. But I'd be curious to hear your thoughts on kind of what we see into the election, what we see into end of 25, and maybe some long-term thoughts there as well.
Yeah. Like the market goes up 85% of the time or something. So, but in election years, it's even more pronounced. So, I've had this theory that I've had this, call it conspiracy theory, call it reality check, whatever, that there is a re-election brigade composed of Yellen, the Fed, policymakers everywhere, that they want everything to go according to plan in order to boost the chances of their candidates. And by the way, this isn't a new phenomenon. It happens every 4 years. So there's nothing new here. It's just in this year, it's been even more pronounced because we're getting used to high deficits. So, these numbers are just getting bigger and bigger. So, we got this year, they juiced up the market. I'm long. I mean, kind of have to be long to an extent. But, at some point, once the election is done, someone has to pay the price eventually, because, we've been running extortionate deficits for the last few years. And the real question to ask is, will they pay the dues in 2025, 26, or are we going to just keep going with this? Now, I think mathematically, I don't think they can keep it going for another 4 years. So as bullish as I am in 2024, there is a chance that I could be as bearish in 2025, but it really depends on a lot of things. Like I need to see a lot of things before I make it's too big a call at this point to get bearish. And I think one very, very dangerous phenomenon that's prevalent on Twitter is that people always want to be like perma bullish or perma bearish, whereas I have this funny Shrub axiom: bears get slaughtered, bulls get slaughtered, shrubs photosynthesize. Because you kind of have to, like, the moment you identify yourself as a bear or as a bull, you're going to get killed one year or another. So 2024, the bears got killed. 2025, it could be the bulls that get killed. So, the setup is there for it. It's there. I mean, we're pretty stretched. They juiced the market too much. They spent too much. the S&P is nearing 6,000. The multiples are high. I mean, you name it. Like they've thrown everything they can to this market, and at some point, someone has to pay, right? So it's just a question of when.
Yeah.
I'm not going to make a prediction who's going to win, because I think the market decided yesterday that it's probably going to be Trump, because the Trump trades have been squeezing yesterday. I don't know why they just decided that's the case. So I'm not going to predict who it's going to be. But all I'm going to say is that if it's Trump winning, it's probably going to be worse for the deficit. It's probably going to be worse for bonds. And I think it's going to be worse for dollars. So that's one thing I wrote today in my piece. I wrote a piece today. I even forgot what I called it already. Let me just see what it was. I had a pretty nice title. I called it
Trump Trade 3.0.
Ah, geez, so
Yeah.
But
No,
anyway,
I had it up. I was reading it this morning. So
yeah. So the gist of it was basically that. It's like, I think what people are missing. If I'm gonna finish on one thing, I'm gonna finish on, Trump was good for the markets, but he was bad for China. He was bad for bonds. He's bad for bonds because of the deficits. But the one asset class that is not responding according to that is not trading as if Trump would win is the dollar. The dollar has been quite strong the last couple of weeks, maybe because of geopolitics. But people forget that last time that Trump got elected, the dollar was down 11% in a few months. Over 2017, the peak to trough drop was 11%. So if I'm going to finish on this, it would be that the Trump trade that people are completely underestimating is that the dollar could have a pretty big move down if all these bad things play out. And actually, that's when you're really gonna see platinum take a leg up, and tin taking a leg up, and all the commodities that you love suddenly are like waking up, and everyone's gonna be like, holy crap, where did that come from? And then you're gonna see the dollar 10% lower. It's just gonna be like a currency debasement trade versus actually a demand-led phenomenon.
yeah, I think that's interesting. I'd be curious to see, because what's going to happen with the broader markets, because like you said, you have all those factors, but you also have the passive indexing. I don't want to call it Ponzi, but like the infinite self-reinforcing cycle of kind of perpetual inflows every 2 weeks. But obviously Mike Green and others have had lots to say about that.
Yeah.
But I think that's an interesting dynamic there. As
Yeah.
far as kind of the signs you're looking for to potentially get bearish or start looking for that decline in kind of broader markets, what signs are you looking for? What kind of
Look,
starts the red
I
lights
think,
flashing?
yeah, I think the precursor is like, just keep it simple. The precursor is going to be the bond market, because the bond market is already like, it's on amber alert right now. It's not on red alert, but it's on amber. So I would be watching the bond market, number one, and it's already flashing those signals. And number two, I'd be watching the dollar, because the dollar is being, like I said, it's strong, so it's keeping the whole thing together. But if you see bonds down, dollar down, I think that's when you need to run for the exit. So that's it. Bonds down, dollar down. Because then you're going to have like, you could have like a panic from foreigners as well. Like, what I wrote today was basically, look, I'm Europe based, and most of my assets are in USD, USD denominated. So imagine if my assets go down in price and they go down in FX, then that's a double whammy for someone like me, which is, most of the funds out there. So I think that's going to be the real red alert.
Yeah, I think it'll be interesting to watch. Is there anything we kind of haven't covered yet, or you think is something to keep an eye on as far as markets, commodities, anything else that you think would be worth mentioning?
Look, I think the only thing that's worth keeping an eye out is China, because people they like to turn very bullish early on, and very bullish quickly and very bearish quickly, whereas to me, it looks like China is actually trying to stimulate, and it's going to take them, a few years to do that. So, the one thing I'm going to mention there is, don't think that they're done. They haven't even started yet. It's going to be about rebalancing their economy. It's not going to be about spending $1 trillion and building roads again. It's going to be a very different setup, I think, this time around.
Yeah, they're not going to be building the skyscraper towns where no one lives and stuff like that.
No,
I think it'll be interesting to see kind of where that goes, because I know a lot of people have been kind of talking about China and some of the geopolitical risk where like they think, oh, they're going to invade Taiwan, this and that. And I don't really see that happening, but I mean, it's possible, but I think it's unlikely. But
yeah,
like you said, I think their economy is going to go through some interesting changes over the next 3, 4, 5 years. So I think it'll have some downstream effects on commodities and other stuff that we've kind of been talking about. But yeah, I think it was interesting conversation. I wanted to pose my traditional closing question to you, which is what book do you think I should add to my reading list? Can be finance, history, anything you think that would be interesting.
so the one I always recommend and that no one ever reads is Dostoevsky's The Gambler.
Okay.
So that's honestly, I think every investor / trader should read that book.
Interesting.
And I'm going to leave it there because I say it's the best investing book ever written. I jokingly say that because it's up there because it just explains a lot about a gambler's psychology, which at the end of the day, I mean, everyone's a gambler in this market. So
yeah, you gotta pick and choose your spots, but that, I mean, it really is speculation to gambling or however you want to phrase it. But there's different. I think it kind of is that sort of market nowadays. So it's definitely something I'll add to the reading list. But I think it'll be an interesting read when I get around to it. So we'll have to do it again sometime. I'd be curious to
awesome.
maybe follow up in 6 months or a year's time, however long it takes, or if there's something that is interesting in certain commodities or interesting in the market. But I appreciate you taking the time. I think with that, we'll be wrapping up. Thanks for stopping by. We'll see you next time.